Every options position has four forces moving it: delta, theta, vega, gamma. Greek letters traders used to measure exactly how a position responds to change. Today, what each Greek is and why it matters for your trade. Delta measures how much the option moves for a $1 move in the stock. Delta runs from 0 to 1 for calls and 0 to -1 for puts. Higher absolute value, higher sensitivity. Apple is at 150, you buy the 150 call, delta is around 50 cents. If Apple moves to 151, the option gains roughly 50 cents. Here is where ArcAlpha makes this concrete. Imagine ArcAlpha flags a stock breaking out after a long consolidation, with aligned institutional flow showing up on ArcFlow. The setup suggests a $5 move in your favor. Your Delta 50 call should add roughly $2.50 in value. There is a second meaning. Delta also gives you a rough estimate of the probability the option finishes in the money. A delta of 50 cents, about a 50-50 shot. Puts work the same way mirrored. A long put has negative delta. As the stock falls, the put gains value. Delta is your speedometer. Higher delta means the option tracks the stock more closely. Theta is the cost of holding the option. Every day, time decay shaves a piece of the premium off, even if the stock does not move. Here is a concrete example: same stock, same strike, two different expiries. Apple 30-day call, premium $3. Theta is around 5 cents per day. Apple 60-day call, premium $4.50. Theta is around 3 cents per day, more expensive but slower decay. Time decay is not linear. It accelerates as expiry approaches. The last week eats more premium than the first three combined. ArcAlpha setups often need days, sometimes weeks to play out. The lesson when buying long calls or puts: give yourself more time. Pay a little more upfront for an expiry that absorbs slower decay. Theta works both ways. The buyer pays time decay every day. The seller, the person who wrote that contract, collects it. Theta is the clock you cannot pause. The longer you hold, the more it costs. Vega measures how the premium responds to changes in implied volatility. Implied volatility is the market's expectation of how much the stock will move. Higher IV means richer premiums. Apple's earnings are tomorrow. The market expects a big move. Implied volatility spikes. The same 150 call that normally costs $4 now costs $8. That extra 4 is pure volatility premium, Vega in action. After earnings, when the uncertainty resolves, implied volatility crashes. The premium drops fast even if the stock moved your way. The infamous IV crush. ArcFlow surfaces unusual IV activity around catalysts. When you see IV elevated, you know Vega risk is high. You may be paying extra for volatility that evaporates after the event. Vega works in both directions. If you bought a call when implied volatility was low and IV then expanded, your premium expands with it, even without any move in the stock. Vega tells you how much volatility risk is baked into your position. Gamma is the rate of change of delta. As the stock moves, delta itself shifts. Gamma tells you how fast. Apple at 148. The 150 call has a delta of 30 cents. Stock moves to 149, delta is now 40 cents. Stock hits 150, delta is 50 cents. That extra 10 cents of sensitivity per dollar, that is gamma. The closer the stock gets to your strike, the more responsive the option becomes. ArcAlpha alerts often surface stocks approaching a key level, a breakout point, a measured move target, a prior high. When the stock is near your strike, gamma is high. Small moves create big P and L swings both ways. Gamma is highest at the money and especially close to expiry. That is where each dollar of stock movement swings the option price the most. Long options have positive gamma, your delta accelerates with you. Short options have negative gamma, delta accelerates against you. Higher gamma means the position becomes more responsive as the stock moves toward your strike. All four Greeks act on every position simultaneously. ArcAlpha alerts a stock breaking out after a long consolidation. ArcFlow shows aligned bullish institutional flow. You buy a 60-day slightly out of the money call. Delta is around 40 cents. If the breakout adds $5 to the stock, the option gains roughly $2. Theta is small. 60 days gives the setup room to play out, and decay is slow until you get into the final 2 weeks. Vega depends on the volatility context. If implied volatility is normal, Vega barely matters. If ArcFlow shows elevated IV, you're paying extra for the volatility premium. Gamma is moderate at the start. As the stock pushes toward your strike, gamma grows. Each dollar of move accelerates your option price. Different setups emphasize different Greeks. An earnings trade, Vega dominates. A long-dated swing theta is the slow leak. A short-dated lottery gamma swings wild. Direction is delta, time is theta, volatility is Vega, acceleration is gamma, every position has all four. Smart traders pick positions that align these forces in their favor. Next in this track, implied volatility and IV rank in depth, the pricing engine behind every premium. All ArcAlpha educational content is for informational purposes only. None of this is a recommendation to buy or sell any security.